Picture this, September 2017. The Christmas shopping season is just weeks away, and America's most famous toy store, Toys R Us, files for bankruptcy with $5 billion in crushing debt. By March 2018, they're liquidating everything. 33,000 employees lose their jobs. 800 stores go dark. And the company that defined childhood for generations disappears during the most wonderful time of the year. But here's what most people don't know. Toys R Us didn't fail because kids stopped playing with toys. They didn't fail because of Amazon alone. They failed because 3 Wall Street investment firms, KKR, Bain Capital, and Vornado Realty, made one catastrophic decision in 2005 that would eventually cost 33,000 people their livelihoods and investors billions of dollars. This is the story of how a $6.6 billion leveraged buyout destroyed the world's biggest toy retailer. How corporate greed, missed opportunities, and crushing debt payments turned America's favorite toy store into a $5 billion holiday disaster. This is the economic event you slept through. Before we dive into this story, if you enjoy uncovering the economic events that shaped our world while most people weren't paying attention, please hit that like button and subscribe to the channel. Ring the notification bell so you never miss these financial mysteries that everyone slept through. Now, let's unwrap this disaster. Chapter 1. The Toy Kingdom. In 1948, Charles Lazarus opened a baby furniture store in Washington, D.C. Parents kept asking him for toys. So he pivoted, and by 1957, he'd opened the first Toys R Us in Rockville, Maryland. The concept was revolutionary. Warehouse-style stores with every toy imaginable, organized by category, at competitive prices. Think of it like Costco, but just for toys. Giant stores, massive selection, reasonable prices. Kids went crazy for it. Parents loved the one-stop shopping. And the business model printed money. By the 1980s and 90s, Toys R Us dominated the American toy industry. They controlled roughly 25% of all toy sales in the United States. Their stores became destinations. The brand became iconic. That jingle, "I don't want to grow up, I'm a Toys R Us kid," embedded itself in American culture. In 1998, they opened a massive flagship store in Times Square, New York, 3 floors, 110,000 square feet, a 60-foot indoor Ferris wheel. This wasn't just a store, it was a tourist attraction. At its peak, Toys R Us operated 1,500 stores worldwide and generated billions in annual revenue. The company was so dominant that toy manufacturers like Hasbro and Mattel structured their entire production schedules around Toys R Us orders. If Toys R Us didn't stock your product, your toy basically didn't exist to American consumers. But in the late 1990s, something started shifting. A little online bookstore called Amazon was expanding into other product categories. And Walmart was becoming increasingly aggressive with toy sales, using toys as loss leaders, selling them at or below cost to drive foot traffic during the holidays. Toys R Us executives recognized they had a problem. Their stores were outdated, their website was mediocre. Competition was intensifying. So in August 2000, they made what seemed like a smart move. They signed an exclusive 10-year partnership with Amazon. Under this deal, Toys R Us would be the exclusive toy and baby product seller on Amazon's platform. Amazon would handle the technology, website operations, and fulfillment. Toys R Us would handle merchandising and inventory. It seemed perfect. The toy expertise of Toys R Us combined with Amazon's growing e-commerce platform. Toys R Us agreed to pay Amazon $50 million annually, plus a percentage of sales. In exchange, they'd capture the growing online market without building their own infrastructure. But there was a problem that nobody saw coming. Chapter 2. The Amazon Betrayal. The Amazon partnership started well enough. But by 2003, Toys ES executives noticed something disturbing. Other toy sellers were appearing on Amazon's platform. Third-party sellers were offering the exact same products that Toys R Us was supposed to be exclusively selling. Amazon's argument? The exclusivity agreement covered Amazon's direct inventory, not the third-party marketplace they were building. It was a technicality, but it violated the spirit of the deal. Imagine your Toys R Us. You're paying Amazon $50 million a year for exclusivity. You're handling all the inventory risk. And Amazon is quietly letting your competitors sell on the same platform, often at lower prices because they don't have your overhead. By 2004, Toys R Us had had enough. They filed a lawsuit accusing Amazon of breach of contract. The legal battle dragged on for years. In 2006, a New Jersey judge ruled in favor of Toys R Us, allowing them to terminate the agreement. Eventually, Amazon paid $51 million to settle barely more than 1 year's partnership fee. But the damage was done. For nearly 6 years, Toys R Us had outsourced their e-commerce strategy to Amazon. They hadn't built their own online infrastructure. They hadn't developed in-house expertise in digital retail. And while they were stuck in legal battles, Amazon was perfecting the model that would eventually dominate online shopping. By the time Toys R Us got out of the Amazon partnership in 2006, they were years behind in e-commerce capability. They'd wasted their best opportunity to build a competitive online presence, and they'd essentially trained their biggest future competitor in how to sell toys online. But the real disaster was still ahead. Because while Toys R Us was dealing with Amazon problems, 3 Wall Street firms were watching, and they saw opportunity. Chapter 3. The $6.6 billion mistake. In 2005, 3 investment powerhouses KKR, Bain Capital, and Vornado Realty Trust approached Toys R Us with an offer. A $6.6 billion leveraged buyout to take the company private. Here's how a leveraged buyout works in simple terms. Imagine you want to buy a $6.6 billion house, but you only have $1.3 billion in cash. So you borrow the other $5.3 billion. Then, and this is the crucial part, you put that $5.3 billion debt on the house itself, not on yourself. The house now owes the money, not you. That's exactly what KKR, Bain, and Vornado did. They put up $1.3 billion of actual investor money. They borrowed $5.3 billion. And they immediately loaded that entire $5.3 billion debt onto Toys R Us's balance sheet. Toys R Us shareholders approved the deal. The executives got payouts. The private equity firms took control. And overnight, Toys R Us went from a company with manageable debt to a company drowning in it. Before the buyout, Toys R Us had been profitable. They generated roughly $11.2 billion in annual revenue. Their operating income was around $662 million. Not spectacular, but solid. After the buyout, everything changed. Toys R Us now owed approximately $450 to $500 million per year, just in interest payments on that debt. That's nearly 75% of their previous operating income gone before they could invest a single dollar in store renovations, technology upgrades, or competitive pricing. Think about it. A company that was profitable suddenly couldn't afford to compete because 3/4 of their operating cash flow was going to Wall Street creditors. But it gets worse. Between 2005 and 2017, KKR, Bain, and Vornado extracted approximately $464 million in fees and interest payments from Toys R Us. They were literally paying themselves with the company's money while the stores deteriorated. The private equity firm's strategy was simple: cut costs, improve margins, sell real estate, and eventually flip the company for a profit. But retail doesn't work that way. You can't starve a retail operation of investment and expect it to thrive. While Toys R Us was making massive debt payments, Amazon was spending billions on distribution centers, technology, and customer experience. Walmart was renovating stores and building out online infrastructure. Target was modernizing. And Toys R Us was stuck writing checks to Wall Street. Customers started noticing. Stores looked tired. Product selection became spotty. Prices weren't competitive. The website was clunky. The experience that had made Toys R Us special was disappearing. By 2010, it was clear the leveraged buyout was failing, but the debt was locked in. There was no escape. Chapter 4. The Death Spiral. By 2015, Toys R Us was in serious trouble. Amazon had become a juggernaut in toy sales. Walmart was dominating holiday shopping with aggressive pricing. Target had remodeled their toy sections and improved their online presence. And Toys R Us was still making massive debt payments with no capital left for reinvestment. The numbers tell the story. Between 2013 and 2016, Toys R Us's same-store sales declined for 13 consecutive quarters. Revenue dropped from $13.9 billion in 2013 to $11.5 billion in 2016. The company was shrinking. But the $5 billion debt pile wasn't shrinking. Interest payments kept coming due. Credit ratings kept dropping. And the options kept narrowing. In summer 2017, Toys R Us executives knew they were facing a critical moment. The holiday shopping season, which typically generated 40% of their annual revenue, was approaching. They needed inventory. But suppliers were nervous about extending credit to a company drowning in debt. Here's the brutal math. Toys R Us needed roughly $1 billion in merchandise to stock their stores for Christmas 2017. But with $5 billion in debt and declining sales, suppliers like Hasbro, Mattel, and Lego were demanding stricter payment terms. Some wanted cash on delivery. Think of it like this. You're running a lemonade stand, but you owe so much money that the lemon supplier won't give you lemons unless you pay up front. You can't sell lemonade without lemons, but you can't buy lemons without selling lemonade first. That's the death spiral. On September 18, 2017, just as the holiday season was ramping up, Toys R Us filed for Chapter 11 bankruptcy protection. They carried $5.2 billion in debt. They listed $6.6 billion in assets. And they assured everyone this was just a restructuring to give them breathing room. Our stores are open, and we are ready for the holiday season, they announced. But the damage was done. Customers were nervous. Suppliers were nervous. Employees were terrified. The bankruptcy filing was supposed to give Toys R Us time to reorganize their debt, close unprofitable stores, and emerge stronger. That's what Chapter 11 is designed for, a do-over, not a death sentence. But retail bankruptcy is different. When customers think your store might close, they stop shopping there. When suppliers think you might not pay them, they stop shipping to you. And when that happens during the most critical shopping season of the year, it creates a self-fulfilling prophecy. The 2017 holiday season was a disaster for Toys R Us. Revenue dropped 15% compared to the previous year. Toy manufacturers started shifting their products to Amazon, Walmart, and Target. And the company started running out of cash faster than anyone expected. By January 2018, the executives and bankruptcy advisors realized restructuring wasn't possible. There was too much debt, too little revenue, and too many competitors who'd already captured their market share. On March 14, 2018, just days before the spring toy season, Toys R Us announced they were liquidating. All 800 U.S. stores would close. All inventory would be sold off. And 33,000 employees would lose their jobs. The announcement came without warning for most employees. Many found out from news reports, not from management. Some discovered they weren't getting severance packages. The company simply didn't have the money. Chapter 5. The Aftermath. By June 2018, Every Toys R Us store in America had closed. The liquidation sales were complete. The iconic brand was essentially dead in the United States. Let's talk about the human cost first. 33,000 people lost their jobs. Many were long-term employees who'd worked at Toys R Us for decades. Store managers, warehouse workers, corporate staff all gone. And many received little to no severance because the bankruptcy estate had nothing left after paying creditors. Worker advocacy groups pushed for $75 million in severance payments, arguing that employees deserved compensation after giving years of service to the company. Eventually, KKR and Bain Capital, under intense public pressure, contributed to a $20 million hardship fund for former employees. It was a fraction of what workers had lost, and it came only after months of protests and negative publicity. For the private equity firms, the outcome was mixed. KKR, Bain, and Vornado lost their $1.3 billion equity investment, but they'd already extracted $464 million in fees during their 12 years of ownership. They'd also gained valuable real estate through complex transactions during the buyout period. The creditors' banks and bondholders lost billions. The $5 billion in debt they'd issued was essentially worthless. Some recovered pennies on the dollar through the liquidation, but most took massive losses. Toy manufacturers like Hasbro and Mattel saw their stock prices drop as their biggest retail customer disappeared. They'd relied on Toys R Us for billions in annual orders. Now they had to negotiate shelf space with fewer retailers who had more leverage. And what about the customers? American families lost what had been a cultural institution. The experience of taking your kid to Toys R Us, walking the aisles, seeing the massive selection, building wish lists, was gone. The void was filled quickly. Amazon's toy sales surged. Walmart expanded their toy sections. Target marketed themselves as the new destination for toy shopping. The $11 billion in annual toy revenue that Toys R Us had generated didn't disappear. It just shifted to companies that had invested in modern retail infrastructure. Some have tried to revive the Toys R Us brand. In 2019, new ownership opened a small number of stores inside other retailers, but it's nothing like the original. The company that once operated 1,500 stores worldwide and defined toy retail for generations is now basically just a licensing brand. The bankruptcy also triggered a broader conversation about leveraged buyouts and private equity. Critics pointed to Toys R Us as a cautionary tale, a profitable company that could have survived and evolved, but was instead destroyed by a debt load it never would have taken on without private equity involvement. Supporters of the buyout argued that Toys R Us was already struggling with competition and would have failed anyway. They claimed the leveraged buyout gave the company more time than it would have had otherwise. But the data suggests otherwise. Analysis by retail experts found that Toys R Us had positive EBITDA earnings before interest, taxes, depreciation, and amortization for most of the period between 2005 and 2017. In other words, the operating business was making money. It was the debt service that killed them. If Toys R Us had retained the $450 to $500 million per year they were paying in interest, roughly $5 to $6 billion over 12 years, they could have renovated stores, built a world-class e-commerce platform, invested in customer experience, and competed with Amazon and Walmart on more equal footing. Instead, that money went to Wall Street, and 33,000 people paid the price. Chapter 6. The lessons. So what can we learn from the $5 billion destruction of Toys R Us? Several crucial lessons. First, understand the difference between operational problems and financial engineering problems. Toys R Us had operational challenges competition from Amazon, changing consumer habits, the shift to online shopping. But those problems were solvable with investment and innovation. What made them unsolvable was the $5 billion debt from a leveraged buyout. When 3/4 of your operating income goes to interest payments, you can't solve operational problems. Second, recognize the warning signs of over-leveraged companies. If a company is purchased in a leveraged buyout and immediately loaded with massive debt, watch carefully. Look at their interest coverage ratio. How many times their operating income covers their interest payments? Toys R Us had an interest coverage ratio close to 1, meaning they barely generated enough operating income to cover interest. Third, understand the incentive mismatch in private equity deals. KKR, Bain, and Vornado made $464 million in fees while owning Toys R Us, even though the company ultimately failed. Their incentive was to extract fees and maximize short-term returns, not necessarily to build a sustainable long-term business. Fourth, don't underestimate the importance of adapting to technology shifts. Toys R Us's 6-year Amazon partnership delayed their development of independent e-commerce capabilities. By the time they were free to build their own platform, Amazon had a massive head start. In business, timing matters. Fifth, consider the broader economic impact of business decisions. When Toys R Us collapsed, it didn't just hurt the company or private equity investors. It hurt 33,000 employees, toy manufacturers, landlords, suppliers, and communities. Finally, beware of companies that can't invest in themselves. If you're a customer, employee, or small investor, pay attention to whether companies are reinvesting in their operations or just servicing debt. A company that can't upgrade stores, improve technology, or enhance customer experience will eventually lose to competitors who can. The Toys R Us collapse is ultimately a story about how financial engineering can destroy operational businesses. It's about what happens when short-term financial extraction takes priority over long-term value creation. And it's a warning about the real human cost of leveraged buyouts gone wrong. Today, when you order toys on Amazon or browse the toy section at Target, you're shopping in the world that Toys R Us's collapse created. The convenience is undeniable. The selection is vast. But something was lost too, a retail experience that defined childhood for millions of Americans. Destroyed not by changing times alone, but by a $6.6 billion decision that prioritized Wall Street returns over sustainable business. The lesson? Not all debt is bad, but when a company is leveraged to the point where it can't invest in its own survival, collapse is almost inevitable. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel, because we're just getting started with these financial, educational mysteries.